guys, welcome back to the Capital Mindset Show. So this is part 2 of this series covering the 4 major financial companies that basically run the payment systems of the world. These are, of course, the American variants. We're not talking about the international variants. So specifically, we already discussed Visa and MasterCard in part 1. In part 2, we're going to be discussing American Express and Discovery Financial Services. So the first one we're actually going to discuss here today is actually American Express. So with American Express, this is a well-known brand. And one of the risks, or one of the benefits actually, we saw with the 2 companies we discussed yesterday, again, Visa and MasterCard, is the added bonus that they don't have to deal with a lot of the risk involved in the actual transaction. So when you swipe your credit card with Visa or MasterCard card, the risk is all on the bank, right? The bank carries on the risk, but the bank stands more to profit in terms of raw dollar amount because they take the higher fee. Visa and MasterCard, they only take a small little piece of that fee. Now, if we go to American Express, this is a whole different animal. And actually, we'll discuss that when we look at the financial statements. But American Express in and of itself is a bank, right? You can actually set up a savings account with American Express. If many people don't know that, but you can actually set up a savings account with them. And each of their cards has different aspects to it. So you have the travel charge cards, and then you have the actual credit cards. But with American Express, you have actually a loan with that company, right? So if I take my American Express Gold card, American Express Platinum card, or American Express Green card, and you swipe those at a merchant, what you're doing is you're borrowing from American Express. They're paying on your behalf, and they're covering a fee on that transaction. Plus, if you fail to pay them on time, they'll take a fee. Now, a charge card is supposed to be paid off in full at the end of the month. That's what separates a charge card from a credit card. And as well as the charge card has annual fees. Well, credit cards can also have annual fees, but charge cards in particular for American Express, they're very famous for their annual fees. And they provide these sort of benefits. We'll discuss a little bit about that, what that means. But basically, in simple terms, American Express purchases these benefits from varying partnerships in bulk, and they get a cheaper price than what they actually provide to you. So they still make a profit, but a lot of the profits come from these annual fees because that's upfront money that they're getting from you. And in that sense, they actually are very beautiful business because they have a lot of people willing to pay. And then that gets to the crux of this point of this video. What's the main difference between Discovery Financial Services, American Express, and Visa and MasterCard? Well, the original 2 that we discussed in part 1, they don't have that same brand relationship with their consumers. While American Express over here has that relationship. When people think of an American Express card, that is the brand, right? And you appreciate that brand. And you hear a lot of people, or you go out and talk to a lot of people who are in the credit card space, they do appreciate that American Express brand. And people who are not in the credit card space, who just are casual credit card users, also appreciate that brand. Okay, and we take a look at the longer term picture of American Express. They've done actually really well. And over here, this massive drop here in 2016, this is actually the Costco drop. Okay, so Costco used to be exclusive American Express, and then they dropped American Express in exchange for, I think it was Visa. So Visa is the one that's accepted now at Costco, and Costco created their own credit card through the Visa network, right? Before it was the American Express network. Now, American Express, like I said, has various business lines. So one of them actually is the network, and you actually can get an American Express card with a bank. For example, the Charles Schwab credit card, which is a Charles Schwab credit card. So it's the bank of Charles Schwab that is the fronter for that money. They're using the American Express network, and they have a partnership in which they also have the Charles Schwab Platinum card, right? Well, that's a little bit different, but getting into that, they do have a network part of their business, and that directly competes with Visa and MasterCard, but the majority of their business is actually being the front runner of the money. Okay, so they lend the money to you in a sense when you purchase something, and you get your thing, and you pay them back later. Okay, so but again, what is the benefit? Well, they can make more money, or they have the potential to make more money in absolute terms. However, they carry on more risk. The default risk is the main risk. Okay, so American Express has performed pretty well over time, about 6,000% since its IPO back in 1982. And then that's not including in reinvesting of dividends, that's just capital appreciation. So if we reinvested the dividends back then, I know the returns would have been much greater. And then we see more recently, since the pandemic, we had a nice drop here, and then it actually has risen about 130%. So now the question is, going forward, what do we see with American Express? Okay, from there, let's actually hop into the 10K of American Express. And the first thing we're going to discuss is, of course, the income statement. So this is the consolidated income statement by American Express. And then we're going to look at the different line items, okay? So non-interest revenues. So you see how they already say non-interest revenue? Well, in Visa and MasterCard, we don't see interest revenue because, again, they don't collect interest income. So when people complain about high interest on credit cards, and they, the normies, I say, will like typically go and say, oh, Visa, MasterCard doing this, blah, 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 blah. But that's because they don't know what they're talking about. So those companies do not charge interest. American Express does, because again, who are you lending from, or who are you getting your money from? In this case, American Express. So we do see, for example, discount revenue, net card fees, other fees and commissions, and other. Okay, so you can see that this is how they kind of separate. And we want to see, of course, all these kind of going up. But for the most part, the largest part is the discount revenue. Okay, so with net card fees, this is actually the part where they are taking the actual amount of money from the credit card user. And again, these are called fees, right? Card fees. Very simple. And then interest income over here. Well, over here, this is actually the loaning part, right? So when you don't pay your full balance, they're going to take a piece of that and other forms of that. So we see they nicely separate all of it. So we have interest on loans. Well, loans can be the actual money that they lent you, because remember, technically speaking, when you swipe the card, they're loaning you money, right? In all sense of the word, you're getting a loan to purchase that item. Of course, you're paying it back, hopefully, but that's the point. And then they are getting some interest on dividends and investments in securities. So they do have investments in other businesses, and it is actually going down. And then deposits of banks and others. So then that's just the interest income on their bank accounts. Okay, so then they have interest expense. Well, they do have deposits. Like I said, you actually can have savings accounts with American Express. And then you have long-term debt and others. So that's, of course, their actual debt, right? So they separate those two, and it's actually very important. So they have deposits that they have to pay interest on, and then they have long-term debt that they pay interest on. And they're nice. Well, they're not nice. They do this because they have to, but they are showing us the different line items and showing us what goes to what. Okay. So, and remember, this is a consolidated income statement. So what's nice about consolidated income statements is it shows us the full picture of the business, right? Because if we just showed one income statement at a time, we would see each individual business. A consolidated one kind of brings it all together. And I got to say, I actually like the way they break everything down. All right, so here we have the expenses as well over here. So we have the card member rewards. So these are, the rewards that you're getting, and you can see how much it costs them. And then you see the marketing and business development. So this is how much they're spending on their brand each and every year. Of course, it's and business development, but let's kind of think of it all as one thing. And so we know that American Express has that brand recognition around the world. Well, how do they maintain that brand recognition? Well, that's with spending a lot of money, getting in your mind, what's in your wallet kind of thing, so they want you to think of, prestige when they think of American Express, right? So you say, okay, American Express is a high-end card, right? The fact that I'm even saying that is evident that, it's kind of working. A lot of people do think American Express are high-end cards, okay? And a lot of people look at that platinum card as something that's desirable, that gold card as also being desirable, et cetera, right? That metal card. Okay, and then we all know about the black card, right? Well, the black card is actually a phenomenal way of marketing things because it's a very exclusive card and only for high net worth individuals. And the fact that it's invitation only, makes it or gives it that allure. And the fact that American Express is, owns that, right? That in and of itself is very valuable as a brand. Okay, and then we have card member rewards and card member services. So this is like, the different perks that you get. So it's just roadside assistance service in some cards, stuff like that. And then of course, salary employee benefits. So at the end of the day, they're bringing about 8 billion. And remember with the last video, and this is for 2021, remember with the last video, Visa and MasterCard, they almost had a 50% net profit margin, I think 51%. And if we're looking at something like American Express, well, clearly it's not, it's like a 25% profit margin, which is still really respectable, but that's about half what it is, right? So, and I'm kind of rounding there because, you know, if this was 24 and that was 8, that would be exactly 25%. So it's above, a little bit above 25%. So on that note, what I'd actually start to say there, oh, sorry, not 25%. My math is off. 33%, 33%. I was thinking something else. So 33% profit margin, which is very respectable, but you know, it's not that 51%. On that note, we're actually going to scroll down here to the balance sheet. So this is consolidated statement of cash flow. So we passed over it right here, balance sheet. So here we can see the total cash and cash equivalents, but they're going to separate that. So right here, we have interest-bearing deposits in other banks right there. So they nice to separate that. They're very well capitalized in that sense. Short-term investments in securities. So that's their securities, very small part of their portfolio. That's considered the higher risk part. And then cash due from banks. So includes restricted cash and consolidated variable interest entities. Okay, so this is restricted cash basically, but we were going to count it as cash. So this is their cash and this is cash due from banks. Okay, so we're going to actually evaluate that. That's about 22 billion. So we're going to keep it simple with that. But again, if you have any questions, comment down below. I'll be happy to respond in a timely manner. So card member receivables. So this is actually things that are owed to them. So receivables in accounting just references something that is owed to you. Then card member loans includes gross loans. So you can kind of read through this, pause it. And then again, if you have any questions, I'm just going to skim through this to not make this video too long. But for the most part, they do have a nice explanation here. I just skimmed through it. Okay, so in the liability section, we do have customer deposits. Again, what does that mean with deposits? Well, deposits is a liability in a bank. Like I said, they are a bank. And again, when we eventually do that final banks or financials video for the sector analysis, I will be going over in greater detail the complexity of a bank's balance sheet versus a typical business. And this is kind of a glimpse at that because this is a quasi bank. So they do have customer deposits. And then, so that is a liability on the balance sheet. Okay. And we've mentioned that here and there before because it's been brought up in conversations about QE and the like, and the nuances of what each thing is. Okay. So accounts payable, this is money that they owe, you know, it's payable, it hasn't been paid yet, but it's owed. And then short-term borrowings, et cetera. This is what we typically look at. So this is a long-term debt. So sometimes you got to be careful on what source you use because some sources actually combine the customer deposits with the long-term debt oftentimes. And the debt looks really high relative to what it really is because supposedly, you know, you have about this cash in there, and that's in the form of what the people have put in there, right? So you buy, you know, different forms of assets with the deposits that you have, and then they're supposed to match, right? And they have, by the way, they have. So preferred notes, shares, okay, we don't really care about that too much. And then cash flows, I think we'll pause there on this, and we'll actually go to Discovery or Discover Financial Services, and we'll have a little bit of a conversation about that. So let's actually go here to Discovery, and let's have a little bit of a conversation about this company. So this company, like American Express, does similar things, except you can think of it in very simple terms that Discovery is the poor man's American Express. That's as far as what we can really say. That's a very quick, it's not really that, by the way. It's just the same as American Express. And by the way, this company came from Sears, but they aren't there with the same brand level as American Express just yet. Can that change in the future? Absolutely. But there is room for Discovery to actually attack a large part of the market. Inherently, when you think of the two, generally, it's a quick thought in the current moment that American Express customers tend to be those that are able to pay the bills better than Discovery. So Discovery inherently has a higher risk associated with it. Now, will this change in the future? We don't know, but that's just a general thought process behind that, right? Or that's the stigma behind it. I wouldn't call it stigma. It's a stereotype behind the two. But again, Discovery has been making inroads and actually has been growing really nicely. So I don't want to say like it's a bad business or anything like that. I hope I'm not coming across as that. So if we look at the back since IPO, and they IPO'd around 2007, terrible time to actually IPO, in my opinion. They went down 75%. It was a spinoff from Sears, right? So we do see that, you know, I think that is underperforming the market. Don't quote me on that, but I think over this time period, that's underperforming the market. And over the past 5 years, I know this is underperforming the market. The market's up by about 80%. in the last 5 years. And, this drawdown hasn't done it any favors, but if you were, one of those S tier market timers, there you go. You bought at the perfect bottom. But, with regards to Discovery, I want to actually come back to this and show you how cheap Discovery is in comparison to American Express, right? But that's with GAAP net income, right? Let's go ahead and take a look at their 10K. So taking a look at 10K, we'll see a lot of similarities. We'll see interest income, credit card, private student loans. So they're also involved in student loans, by the way. And then PCI student loans, personal loans. So they're doing all these other things that American Express really isn't diving too deeply into. So they are, again, they're competing against American Express, but they're also getting into other businesses that aren't really competing with American Express. And that's good for this business because I think they should be focusing on finding ways to derive value because directly competing against American Express in terms of branding in the present moment is actually very difficult. Okay. And I'll have a little bit of a discussion at the end why there are some advantages and disadvantages when compared to the original two stocks, Visa and MasterCard. Okay. Because there are some advantages and then disadvantages. So we did like talk about a little bit about the volume or the nature of the volume. So in the sense of Discovery, right, we do see that their volumes are actually a little bit lower, and we see transactions processed by networks this is the network of Discovery, right? But remember, Discovery is also a bank, so they are actually also loaning, but they also have the network business, which is what you can think of when you think of Visa and MasterCard. And then so they do have some, these are the volumes, by the way, because it's transaction volume, transactions processed. So I want you to actually think of it. I think these are the actual number of transactions, and these are the volume in dollars. Okay. So that's, I think, in billions or millions. So it's 150 billion. All right. And if we go to American Express, it's, I think it's almost a trillion. It's like 80 something billion. Well, is it 80? Yeah, it's 80 something or 8,800 billion. Yeah, it was 800 billion, I think was the number. Okay. So, this is actually what I came down here for, allowance for loan losses. So this is actually what I want to highlight with that is, again, they're going to highlight throughout this 10K a little bit about what are the risks associated with their business, and its allowance for loan losses is an account that they're going to put in there because we do have to understand that the added risk associated with this business is, people don't pay you back, right? Because you are at the end of the day a bank. So they are a bank basically with a network, a direct network link to the customer. Chase Bank, for example, operates on the network of Visa. And so they use the network of Visa, but they are loaning it every time I swipe, with the Chase Sapphire Reserve or Preferred or Freedom or whatever. They're going to loan me the money. I'm going to get my good or service, and they take on the risk. Visa is just the guy, setting up the transaction. He's like, okay, you want to lend this person money and you want money. Boom. I make the deal happen, and I take a very small cut. Well, American Express and Discovery, again, I think I've repeated this many times now, they are actually loaning to you the money, but they also have a network in which they can offer that to banks, et cetera, that can then use their network. And then that's a high margin business. Okay. So from here, let's actually go ahead and go to the model. I've already plugged in American Express. So just so we don't waste any time, and then I'll just plug in Discovery after we're done with this one. So with American Express, we do see that, let's actually come down here and kind of make a point here. The revenue has actually grown drastically. They do benefit from a cashless society. American Express, though, again, has that added nuance to their business model where they are a brand. They have a relationship with the customer, and they actually one of their selling points, what they do to merchants is they say, our customers tend to spend more than the average customer. So you should accept our card there, even though they have the highest fee. And if you're a merchant, you can actually attest to this, that American Express cards do have the highest fee in the transaction because they do make that initial money in the transaction. And then if you don't pay them, they make additional money. So American Express, if, for example, everyone in American Express were to pay their American Express card on time, and I'm talking about the credit cards, they still make money from the transaction fees. Okay. They still do make money. People think that if you pay off your credit card, you're screwing over the credit card companies. Like, not really. They actually would love that because you're basically eliminating all risk. If you could guarantee a credit card company, hey, all your customers are going to pay their bills on time and exactly the amount they spent, that's awesome, because I'm basically just going to collect a fee, right? A transaction fee every single time. And that's really good. Now, if you have the reason why we have interest rates or that are really high on credit cards is because they're unsecured loans, right? If you don't pay back the credit card, they don't have anything to really take from you. And that's the nature of unsecured loans. Higher risk, they will demand higher rates of return because the ones who are paying are making up for the ones that aren't paying. Okay. And so you could have a situation again where American Express says, no credit cards whatsoever, only charge cards. And again, charge cards, they tend to want to target the higher income audience, right? Because again, those are more likely to pay back. All right, so after that spiel, let's get back to this. And we see that the estimated revenues are expected actually to decline in 2022. Cash flows are expected to also decline, and then more in line with the trend line. So this trend line is actually, coming to fruition, and this revenue trend line, same thing. And then shares outstanding, they are cannibalizing. So just because revenue is coming down, cash flows are coming down, doesn't mean the cash flow per share won't go up, because they are cannibalizing their own shares. And we can see that they've averaged out the buybacks about 3.43%, which is really nice if you can kind of think about consistently going forward over time. Now, we are discounting it at market rate of return above 10%. And we can see that we don't have it to expect actually a lot of growth to actually say that this is at fair value. But that's actually going into the cash flow numbers over here. So the PE is about 16, but the price to free cash flow is about 8.83, right? And in this instance, it's actually more favorable or better, because it is a financial business, to actually look at it at the earnings. Similar to a bank or an insurance company, it's sometimes, not sometimes, it's better to look at the earnings than the cash flows. Okay. So what I'm going to do here is I'm going to tell this business or the model to make some change. And I'll show you guys that in just a second. So if we switch over here and we say we take to the adjustment, right? And then we take into account the net income instead, this is the new picture. So if I say no to this again, no, we're using the cash flows, right? But again, in regarding to American Express, since it is a bank-like institution, it is not ideal to use cash flows in this instance, right? It's actually good to use GAAP net income. So GAAP net income is a more fair measure or reflection of the underlying business performance than the cash flows. Again, because of all the complexities of what it is that's going through in and out in terms of operating cash flows, it isn't really fair to say that the cash flows are actually what can be returned to us as shareholders. So we make the adjustment, and then we basically entrust ourselves with GAAP in this instance, which is typically counter to what I usually say in regards to most businesses. But again, that's why investing is so nuanced. It really does depend on the business, the circumstance, the time of day, in which case how we analyze something. So taking a look here, now the picture is a little bit different. So it makes a little bit more sense, this big run up, why now it's a little bit more expensive than what I'd like. But if we do expect a 10% growth, we are undervalued. Now, if we want a higher margin of safety or a higher rate of return, we do see that we can't expect the same amount of growth that they've had in the past. We actually have to expect more growth, about 15%, 14%. I think 14% might be an amount. Oh, I did it again, like right there. Let me see. There we go. 14%. Yeah, so with 14%, we do see that it's still, well, actually, no, that's a huge growth. Because this went back to, I need to do that. All right, 14%, we do see that it's more or less at fair value, actually, but 14% and above is what we'd have to expect in order to achieve that 15% rate of return. Now, if we do start assuming that there will be some share deletion, let's say about 3% or so, we do see that it's actually, we can expect, I think maybe, let's see, a 10%. Yeah, we can expect exactly a 10% required rate of return, sorry, a growth rate here going out into the future. And that would, achieve that. But, we are making an assumption here, and I don't really like to make this assumption. Let's say maybe 1%. I did it again. At 1% there. And, okay, so, I mean, what can we assume? We can assume probably at 12. Why does it keep doing that? That's interesting. 12%. Okay, so 12%, 163. That's fine. I mean, that's more or less in line where it is right now. It's not too far. We're at 169.87. I forgot to mention to you guys, you can see down here that the analysts have it rating of a strong buy, price target of 205.71, implying a 21.10% upside. Okay, so with that being said, I do think that this business is, fairly valued right now. It's not like it's not overvalued tremendously, but it's also not a value that I'd be like, oh, I'm really interested in this business. I am interested in this business at some point because it does have a very strong brand. This is actually one of Buffett's big investments as well, and I think he invested in it because of that branding. So they do have a lot of power. So I'll actually go ahead and plug in Discovery, and then we'll come back to this, and we'll go over here to American Express, have a little bit of discussion about some of the advantages and disadvantages. So compared to Visa and MasterCard, we do know that they have higher margins. It appears that they have the higher moat, right? But that's an appearance because of the margins. I think American Express has the higher moat. And the reason is because not only are they the network, but they're also the branding, right? That's very important. I think people underestimate the power of that. So when you think of American Express, it's American Express, right? You have a relationship with American Express and they control the customer. Visa doesn't control the customer. Visa is just the network and their customer is actually the bank, right? You are the user and the customer of the bank, right? So American Express, by controlling the full funnel, right, for the customer, they can establish more of a connection, and that branding power is just, it's really not appreciated enough, right? So that's an advantage. And then should something change in terms of how we use money, et cetera, the American Express can still adapt, right? Because they can still be that brand, that loan to you, that bank in a sense to you, and then in that sense you will still always be using them. Okay, so now let's go back to see Discovery Financial Services. And with Discovery Financial Services, we do have to make the adjustment right here to the cap. All right, so when we look at Discovery Financial, we do see, obviously, compared to American Express, they're extraordinarily cheap, right? So if we take a look at, for example, the price to free cash flow and the PE, they're actually more or less in line, which is interesting. But again, we want to use the GAAP net income for something like this, an entity like this, because it is a bank of sorts, because they are lending out. So it actually evens out the complexities. So what I'd say is the market is a little bit more cautious, if not a lot more cautious, on something like Discovery Financial Services because of the investments that they're in. And they're actually, interestingly enough, well, let's see actually what the estimates say. The estimates are, again, coming down a little bit, but in the cash flows, they are actually estimated to rise. They are also doing the same amount of share dilution, or sorry, deletion, not dilution. And with that being said, they are obviously here priced way cheaper than something like American Express, right? Now, are they rightly so? Is there a reason as to why that they are doing this? Well, I'd say that absolutely, because if we're looking at what Discovery Financial Services is involved in, it is higher risk. Of course, higher risk, quote unquote, higher reward. I guess you could use that logic there. So if we discount, for example, Discovery Financial Services at higher and higher rates, we start to see that it looks extremely cheap on paper. So with Discovery Financial Services, what I'm going to do is, after this video, right, after this video per se, I'm going to do more research into Discovery Financial Services to kind of drive what I think is a fair value of this business. And it may actually end up being the case that it is undervalued. But the model is kind of showing me here that this is a very undervalued business on paper so far. Now, what's key is having these estimations a little bit more correct or accurate, because, for example, if we know that there's going to be some sort of decay, about 10% decay, you can see that we're actually overvalued, right? But that's an extreme decay. But even 5% we're overvalued, let's say negative 2% overvalued. So we are almost there. And let's see if it's a negative 1%. A negative 1%, we're basically there. What about just zero? Well, at zero, yeah, we're very close. And then 1%. Okay, so even at a 1% growth rate going forward, we're actually at fair price. And they have been buying back more shares than American Express. So I'm interested to see what this business is like under the hood a little bit more in greater detail. So think of this as the preliminary analysis, and I was covering all four companies. The one I'm actually going to take a look at further is Discovery Financial Services. and then kind of get an idea of what the heck is going on. Is the market mispricing this, or are what's under and their balance sheet really risky, right? If it is, then that's what the market's kind of trying to tell us by this really cheap valuation. So sometimes, things are too good to be true, right? But sometimes they're not, okay? So let's take a look real quick at the ratios to get an idea of some of this. Again, some of this we got to take with a little bit of a grain of salt. However, for example, the long-term debt ratio, this one should be accurate relative to their debt. So the model is actually parsing it correctly versus other websites that don't parse it correctly. They actually lump it together as a total debt. But anyways, when we're looking at the current ratio, and we can actually take a look at the longer term right here. So looking at 10 years instead, we do see that the current ratio or the liquidity ratios, we can't really talk about these in a financial business. Okay. So I just want to point that out there. Again, that will be more explained in detail in the video dedicated to banks and financials and the like. But for the most part, you can't really look at those too much because this looks terrible, but it's under the context that they are financial businesses. By the way, American Express, more or less the same thing for that. And then solvency ratios, we have the total debt ratio, long-term debt ratio. Things have been improving. Actually, the business has improved outside of the pandemic on the other side. So I really like that. Long-term debt to capital, debt to equity. So some of this stuff, again, you don't want to pay too much attention to, like financial leverage. That's fine for an entity like this. Interest coverage, that's fine. That's really good, actually. For an entity like this. The DuPont analysis, we don't really look at the gross profit margins. We'll look at the operating margins here, net profit, ROA, ROE, all solid. The ROIC is what I'll actually pay attention to with businesses like this. That's actually really good ROIC. Earnings quality is actually really good also, but that ROIC is actually really impressive. So we'll actually go here and change this to AXP and then go to the ratios again. And then we'll wait for the change to occur, but it'll take a minute. All right, I think it just happened. So current ratios, you see, I told you I wasn't lying to you guys. They're about the same in terms of they look bad. And the solvency ratios, again, they've actually shown improvement here in the long-term debt ratio. So really good. And like I said, financial leverage is about the same, in terms of what it looks like. Gross profit margin, again, we're not going to really looking at that. Ignore that 100%. That's an anomaly. That's not supposed to be there. Operating margin, net profit margin, pretty good. And it's the ROIC I want to actually skip over and come down to. So what's unfortunate about American Express is that they're unable to achieve higher levels of ROIC, which is actually a negative, but it's very lumpy. So some years it makes up for previous years. So like in 2018, that's terrible, but 2019, that's fantastic. 2020, that's terrible. 2021, that's fantastic. So they're very lumpy, while Discovery Financial Services seems to be a little bit more consistent, but their earnings quality is also on par. They're very good. So I'd say they're both good companies. What I need to make sure is look at Discovery Financial Services in greater detail, figure out why it is they're so cheap. What is the market seeing? Like what's going on there? Okay. So I'll be making a video just dedicated to that. And again, a video dedicated to just the financials. It will be coming out hopefully within the next month. It depends on what time allows me. But that video is going to go into more in depth about the accounting of these different entities and what are some of the nuances, what separates them from traditional businesses. All right, guys, on that note, I'll hope you guys enjoyed this video. And if you guys have any questions, comment down below in the comment section. I'll try to get back to you at a reasonable time. And if you guys like this video, go ahead and feel free to leave a like. And if you're not subscribed, go ahead and subscribe and come back for more content. Maybe we're covering the video that week or that day of a stock you're looking into and you want a different, fresh perspective. But on that note, guys, I'll see you guys in the next one. Bye.